Okay, so we're live. Okay. Is the sound loud and clear? Like, can anybody tells me that my sound is loud and clear? We are going to start at 8 o'clock. So as usual, we will be waiting more to actually squeeze in. No. Okay. For those who just joined, come and say hi. Yeah, optional hunter is here already. So today's sessions we are going to cover the debit spreads. Is almost coming into the ends of the options spread book series already. So I think this one is the chapter 8. You know, hey, welcome guys, welcome. We are going to start at 8 o'clock so that we'll wait for the rest to actually comes in. So yeah, yeah. If you haven't actually, so we are new to the options playbook channels, you can actually follow the page like in the chat box there, so that we do share a lot of the those option trading educations webinars. And today's sessions, we will be covering the chapter 8. So come and say hi if you have joined the sections. So let me know that you're ready to go when we are uh, we're at like 55 now. Yeah. Oh, hi, Rosum. Yeah, welcome back. Welcome back. How you go? How the goings? Like, is everything good for you? Yeah, nice to be back. You did join the Moneymaker series, is it? Like on Zoom? Hi, everyone. Hi, everyone. Yeah. So I hope I did not really lots of the technical things that I have shared that during the days. Is just like delivering those kind of concept. So I hope you you do enjoy the whole series. Yeah. So, you're from Singapore? No, I'm from Malaysia. I'm from Malaysia. But sometimes I'll be visiting the Singapore to for certain event as well. Yeah, especially Elwin's. Like Elwin, some been there for a few times, like conducting the some of the training sessions with you guys. No, when you both be at Bugis again? Not sure, man. Because like now we got a lot of projects, but mostly will be online, and then some of them like will be busy with the offline event at the in the Malaysias. So not sure when we are going to do that again. So yeah, but rest assured, I'll be also like sharing those option tradings contents with you guys lah. Thanks for this talk. I'm comfortable tradings, but I think a talks will benefit everyone's level. Then thanks for this call. Yeah. Hope to see you both here. Yeah, but yeah, I have to like it depends, depends. Not every single times we get the chance to actually visit the Singapore. It depends on like is there any things we need to talk about because like we still got a lot of things to actually to do into Malaysia's like like because we just a very quick questions, right? Since like I see most of the people is like already coming since like we still have 3 minutes 3 minutes to go before we start. So like after this whole option playbook series, right? Do you guys have anything want to like really keen into it? Because I really want to like listen to you guys like what kind of a content do you guys want to see? Like do you guys like do you guys explore strategies or do you guys like love to like conducting the option trading based on your own thesis? Just a quick questions. Yeah. Oh yeah. Has anybody like got their physical options playbooks? If let's say yeah, please type Y. Yeah, So yes, just really for curious for that. So we got 2 minutes left. Yeah, one by. Yeah, how to get. Oh yeah, you can actually it's like is this human or AI talking? It's human. It's human. Legit human. Legit human. It's not AI talking. Okay. Right. Yeah, me and option hunter is human. Okay. Simple traders like how you actually get it. I think you need to like you're from Singapore or like Malaysia. Just if let's say but uh if you're from Singapore or like from Malaysia, you can actually like visit those officials Moomoo website, like see like is there any event that we conduct able to actually claim the book because it's not for sales. It's entirely like free for the it's entirely free for people's but to get it, but there's some certain events and a requirement to actually get it. MY, yeah, but I think it's like you have to stay tuned for our next events, because like I think we still have like some of the events that are able to actually for you to actually claim the books. So yeah, okay. Uh, for give that sick of losing money account size for 2,000 down. What have you done? That's almost like a 50% drawdown. Something wrong with the strategies or maybe the position sizing, I guess. You mentioned last sections if you're keen about long-term credits, things like that, let you know that you could conduct some. Yes, definitely we'll do that. Okay, right. So yeah, because like you guys know that I'm a systematic traders, right? And then if you guys do actually like um uh we sit we sit the, the session that that I joined last 2 days, I guess, the money market maker series, I do mentions that how I deploy my strategies. Like, you guys do remember how I actually is like deploy my strategy? If you guys do, like, let me know in the chat box. No, I okay, but I guess nobody. Okay, so so since we're going to have a little chat later, so that since like the today's topic is more on the debit spread. Okay, so like let's get started. Like if you guys can have ready, then please type one so that I'll be starting the sessions. Can you guys do that? All right. There's a two. Okay. All right. Thank you guys for the comments. Like I'll be starting my sections now. So like today's sections like will be a very fast one also as well. So of course last but not least, like we will have our disclaimer as well. Everything I said today and mentions any ticker symbol or maybe it's like the product features, all those kind of strategy is just for like education purpose only. It doesn't becomes financial advice. Okay, please be mindful and be aware of that. Okay, so like in today's sessions, I'm going to teach you guys like trading directions without overpaying. Okay, because like I understand that a lot of the people actually is like want to like pay small. You know, like you have like a 3,000 to 5,000 US dollar accounts, and then when you are actually looking at those mega cap stock, right, and then you realize that even the option itself also expensive, right? E- Even you know that options can do can leave becomes a leverage tools for you, but you find out that it's still very expensive for you, right? For some many traders, like you're actually very good at identify a stock directions, yet you're still losing money because like sometimes the IV very high, the option that you have bought is way too expensive. So that this is where the debit spreads comes in is solve your problem by reducing your cost. Also, the best part is from a probability perspective, it lower down the break-even points so that you have a much more higher probability for your options going in the money. Okay. And then also it's like defining your both risk and the reward as well. Because like so how does it actually works? Okay. To understand a debit spread, right, you have to think of it like a subsidized ticket analogies. Like you are paying less to actually participate. Okay. So in if you think that if you thinking in this way, basically we are focusing on reducing the cost of participation, like not maximizing the price. I understand that a lot of you actually when you tap into the options tradings, you're actually like buying a course, right? Like a long course and all that. But sometimes long call just way too expensive and the absolute amount is way too big for your account size. So like the focus is to reduce your cost, which is reduce your risk exposure, but not maximizing the price, which is like a what long call can give you like an unlimited profit. Okay, so then be mindful of that. Like if you are doing this, and then you like imagine you have to participate in an event, but the entry ticket is too expensive. You are willing to actually accept a smaller predefined outcome if it allows you to enter at a much more lower cost. So instead of paying the full ticket yourself, you're accepting contributing from someone else. In exchange, you agree to give up the winnings beyond that certain level. That's basically the whole story about this. So like the problem is like I mentioned is like the long call, like you express the directions, you buy a call, you express your call directions with of the asset so that in debit spread, right, your long options will becomes your profit engine. Okay. Your profit engine. And the short call will becomes the one who subsidize your cost to finance your long call. Okay. So that remembers that in debit spread, in this case, the vertical debit spread will be having two legs. Will be having two legs. One is the long options, another one is the short options. Remember, the long one is your profit engines, and the short one, it will be the options that to finance your long options. And then the trade-off is you cap your upside. Okay. So why actually is like you doing this? Because like the overpriced ticket, sometimes the IV just way too high, or maybe even the IV is low. The absolute amounts of the options is just way too expensive. It's a very huge upfront cost to tie up into capital, and then it creates the massive risk because like if the trade goes wrong, like when the IV is high, like in the your options getting elevated, and then you just long a call, IV drops, and then you lose money. Okay, you lose money, and then the market went sideways, you also lose money. So yeah, it's a slow bleed, you know. Like if let's say the market just like went sideways, the time decay eating your profit and contract premium every single day. So basically, you lose money every single day, even the stock doesn't drop. And then the high hurdles, like you guess the directions right, but the stock didn't move enough to your huge 1,500 cost. This is the problem. Okay, this is the problems, right? Because like sometimes it just move a little bit, but it doesn't move beyond your break-even point. So you still lose money. Okay. So debit spread actually it solve the problems, right? Like because you only like instead of paying like 1,500, you actually only like have to spend like around like 500 on the bull call spread if you're expressing a bullish wheel. Okay. The advantage is that you also control the same exact directions wheel. The directions it will be the same. You are expressing a bullish wheel, then it will become in the bull call spread also can be expressed as a bullish wheel, but you risk less capital upfront. Okay, you're risking less capital upfront. And even though the market went sideways, the option that you have sold is decaying, so that it acting like a shield to cancel most of the time decay. Okay, so that when it's sideways, your short call also generating profit for you if let's say it move sideways, so that it reduce the data. It reduce the data numbers so that your decay will be slowed down. And also like of course you will be lower down your break-even point as well because your cost is low, so that your break-even points will be low as well. So yeah, so we will have this kind of background. If you guys understand what I just said, please type 1. I want to make sure you guys like understanding why we are doing what we are doing right now, the debit spread. Okay. Right. Oh, Scorpio, you came. I just saw you. Yeah. Okay. So we have our understanding, so that it's not like you want to like unlimited profit and all those kind. It mainly to reduce your cost, especially if you have a long term outlook that you want to buy very long expirations options. Okay. All right. So who should actually consider this strategy? It's engineered for cost conscious tacticians. Okay. Remember, it's the cost. So the capital requirement for this is like low. I would say it's just like low to medium because it's suitable for those account that want to trade the high price asset but cannot be absorb the full premium loss from a naked options. Okay, this one I think you guys can relate because just like the example I have shown you, and also the risk profile I would say is moderate because you accept the upside in exchange for a higher probability. Remember, it lowers down your break even. And then also you have a defined directional exposure as well because like you're expressing a a, a, a bullish view, then you also improve your break even point. And then what is this for? Because it will be, I would say it's like short to medium. Some people will be saying that, okay, Elwin, you just say it's like short to medium, like, but does it works in the long term as well? Yes, it works in the long term as well. As long as you have a defined time frame that you think the stock will move to a certain level within the periods of time. So we have that things clear. So you might wondering like when to actually use this strategy. Okay, in debit spread, it's just really similar to what I have shared in the last sections. It's just like credit spread. There will be two strategies comes into play. The first one, we call it the bull call spread. So that in bull call spread, basically you're expressing as a wheel that is steady upward gliding move. Okay, it's a moderately bullish wheel rather than an explosive breakout to the moon. Okay, remember that if you are doing a bull call spread, you are moderately bullish. Okay, because you already have a specific upwards price target, and the absolute defined risk. Okay, so this is a bullish width for bull call spread. So, and then we have the second strategy, which is the bear put spread. Okay, the bear put spread. So if let's say we have a bullish, of course, we definitely need a bearish trade as well, so that the width is like you're expecting a steady downwards. If you think the stocks will be coming down, and then you, like, for example, it's like the market will crash or something else, you can actually do a bear put spread. It's like a long a put, but you short another put to actually to finance your long put spread. Okay, so that this is the downward prices. Okay, so why this strategy works? Because it's combining the defined risk with a probability based return. I have mentioned many times, when you trade options, you always think of probabilities. Okay, and the debit spread basically solve the problems, right? Like a lower entry cost, the data protections is not really protect 100%, but it reduce your data to actually eating up your options premium, and it lower down your break even. Okay, so yeah, so the math is like this: like if you buy a call, like assumes that the stock XYZ is trading at $100, you're moderately bullish. Okay, traditionally, what you would do, what do you do is like, usually it's like, if for beginners, they love to do just buy a call because they are long, as simple as that. But the problem is what? The entry cost is way too high. Sometimes they didn't check the IV. Is the price being elevated? They have no idea, because they are beginner. They just entry into the long call without checking anything that is available in your apps. Also, that your break-even price will be $100 plus the $5, it will become $105. That's because that's your cost, right? So it adds up. The price from $100 have to move beyond 105, then you only can make money. So that's a long call, right? So, but if let's say that we buy $100 call, and then we sell 105 call, the highest strike, okay, which means that we are buying the long leg. We call it long leg, okay, the long legs. This is our option jargon, because in the futures, if you're reading some articles from the options regarding some of the options, right, the leg, we always like refer the single positions like it's a long leg or short leg. Okay, remember that it's covered in our chapter 2. So the long leg, you'll be cost like same, like $5, but because you sell another leg, like 105 leg, so because you're selling an option, so that you collect the premium, so that you collect $2 premium. So 5 minus 2, how much you are actually paying? You're actually only paying $3, but because of one options equals to 100 shares, so that you're only paying $300 premium. So that because you're only paying $300 premium, so that your break even will be lower as well, so that you are only paying your break even price will be 103. The price only have to move beyond 103, then you can make money. While for the long call, you have to move beyond 105. So in terms of the probability, which one is having a higher probability to actually make money? Can anybody tell me? Drop down in the comment section, so that I can see it's like which one have a higher probability to actually make money. Mm-hmm. Can anybody reply me in the chat box? 103. Yeah, it's a very simple math. So this is how you actually can do the spread, and then you even lower down your whole maximum loss. So how do you actually trade this strategy, which comes into like what you should be thinking when you are actually choosing the things, the doing the debit spread. As always, you guys know that the step 1 also is choosing the right underlying. Okay, it's always choosing the right underlying, because the success always start with selecting the high liquid stock or ETF, because debit spread involve buying and selling options, right? So that you also have to find your outlooks, right? I always say the first step is always outlook. Your outlook can be derived from fundamentals, whether you think that the earnings will be strong in the long run, will be going up. It's entirely up to you. But if you are technicians, you can actually use it as an entry as well. Like for example, if let's say the price, you think that the support will be at $90. Okay, so when the price hit $90, you can enter into the bull call spread. Then you're expecting a bounce back, or maybe like there's a double bottom. If it breaks out already, you can do a bull call spread as well if you are technical driven. Okay. Also, you also can actually align with your macros to see like the sector momentum. You can actually allocate those bull call spread on the different stock as well. So last but not least, you remember always check the spread. Spread is really important, really really important, because like some of the stock, that those kind of small cap stock, their options is the liquidity is horrible. Okay, not saying is that it's you cannot trade the small cap stock. It's just saying is that you have to be mindful of that. Generally, like the small cap, like the liquidity is really bad. Okay, but so stick to the liquid one. Okay, that's the rules. It's not like I only buy the mega cap, I only buy the large cap. No, if you want to buy the small cap, make sure it's liquid as well. Okay, and then also you have to choose your direction, because you did your analysis already. You must have your outlooks right. You saw that whether you are bullish or bearish. If you're bullish, then you just go for trade bull call spread. But if you're bearish, then you just trade bear put spread. As simple as that. Okay. So what you do is that the next part is that selecting your expirations. That remembers, like I mentioned, that you can do a short terms, you can do a mid terms like 30 to 45 days, or you even can do a 60 to 125 days, those kind of things. You can create this spread. Then what I love to do is always like switch to custom. Don't worry, like you actually is like don't know how to do it, because I'm going to show you guys in demo later. Okay. And then selecting your strike. Remember, when you select the strikes, right, you actually have three ways to actually select. One is at the money, in the money, or out of the money. It's entirely up to you. Okay. So you can choose any kind of the strike price, but one of the things you just have to be mindful is your delta. Because remember, this one is your engines, right? Your engine, if let's say you bought a Ferrari, the stock went up fast, then your options also making more money. But if let's say you bought a Toyota Vios, compared to the Ferrari, is much more slower, right? So the same directions of the underlyings move up, you may be making less money. Okay, that's the things you need to be mindful. I'm going to visualize to show you how it works. Okay, so the short leg basically is the price that you find to finance your long leg. Okay, so we have these understandings already, and you just execute the trade. And then remember, you are doing a debit spread. So in this case, it's not like credit spread. In credit spread, you sell the spread. But in bull call spread, a debit spread, you buy the spread. Remember that. Okay. Remember, you click buy, not sell. Okay. If let's say you're doing a sell, it will become a credit spread. So be mindful of that. Okay. The management is what, like, if you could actually close the position whenever the underlying price hit your targets. Or you also can take the profit earlier if like closing the position by selling the spread back at the 50% or 80%. Is entirely up to you. Okay. It's quite rare for people actually like holding through the expirations. It's really rare. Okay. Especially when you dip in the monies already, you don't want to the short leg got a sign, you got your profit is almost close to your max profit, then you may consider to actually close your position. And then if let's say the things doesn't work out, like you're having a losses, you can choose to close the spread to limit your maximum losses, or maybe you just hold it through the expiration, and then you let the max loss do the job. It's defined already. Okay, because the max loss you can the maximum loss you can afford actually just like the debit that you have paid. So that we were having a some of the example like Nvidia's like is $400. You think that it will goes up to like $420 over the next month. So you think that the naked call will be cost 1,500? It's kind of like too risky, right? Like so you're going to do a book or spread. So 400 calls, maybe you'll pay $50. If let's say you're naked, it's like $15. But you sell another call that collecting is $5. So how much you are actually paying? How much you're actually paying? You're actually just paying $10. You're actually just collecting $10. And then your max risk is just $10. And then you multiply 100, it's just like $100. So your max reward, it will be the same as well. Your $20 with this one. 420 minus 400. Okay. You buy at 400, but eventually you sell at 420. So you have got $20 profit if let's say both in the money. But because you got the cost, so you minus 10. So your maximum profit is only 10. Okay, I hope you guys do know the math. Okay, you have to minus your cost as well. You eventually, if let's say you got both leg got exercise already, you buy at 400, you sell at 420, you got 20 profit. But because you paid the $10, and then so that you minus 10, then you have the maximum profit you can make is $10. That's how it works. Okay, if you want to know the calculation, but you don't have to do that because like the Moomoo apps already help you to do it already. So that the outcomes is, if let's say you the Nvidia went up to like 225, both are in the money. So you no matter how you're also making the $10. There's 100% of the returns. And then if let's say it went flat, eventually it expired worthless, then you just lost the premium that you have paid. So the example to assuming the Tesla is like 250, you think that it will drop to 230 over the next month. So a naked put is really expensive. Okay. Sometimes it's like it will be costing you about $12, something like that. Then you sell another put, you lower down your cost. So the cost will be $8. So that your maximum profit is how much? Eventually this one is how you short at 250, but you buy back at 230. So you got profit of 20. But because your cost is $8, 12 minus 8, it will be $12 profit. So that's how you actually how calculates your max profit. So eventually it will be the same. If let's say the Tesla really went down to 220, and then your profit will be around like 150% return. The loss, the $8. Okay, the $8 might multiply by 100, 800. Okay, are we clear? If let's say guys are clear, please type 1 in the chat box. Okay, I do want you guys to actually understand how it works. Okay, glad you guys can actually follow. So before I went into the platforms, right, I have to like, of course, we need to cover the risks and the rules, right? Like the frustrations of the cap upside, because sometimes, right, you're choosing the bull call spread already, then the stock like pull a moonshots move, like suddenly it's like 200 shot to like 500. Sometimes because your profit is capped already, so that no matter how much it went high, your profit is defined as well. So that you have to be mindful. If let's say you already expect a moonshot, might as well you just like long call, right? You can actually capture the whole movement. But if let's say you don't think it will moonshot, you just do a book call spread, then you can lower down your risk. But if let's say even though it moonshot, you have to accept that the profits is already defined, and it's a good thing, because for me it's a good thing, because like eventually it's also relative to your cost, right? Your maximum risk. You are reducing your cost to actually entering into this trade, and you didn't lose money. You didn't lose the money. Okay. Oh, okay. So this is why you have to accept the cap upside, and also the pin risk, because like if the stock like close exactly is like on the expiration, your long leg expire, but you didn't close your position before the expiry, but then out of a sudden your short leg got assigned already, then you didn't exercise your long leg. Sometimes the pin risk can happen. Okay, make sure you actually close your spread before the expiration. If you already have a profit, or maybe it's at the money, there is losing a little bit. Okay, and then don't leg out. Never add leg out. Okay, because like some people's like sees like when the price goes down, your short leg is making money already, then you close it, then your long leg still losing money, so you're expecting the long can be goes back up. That's not wrong if you are managing that way. If you are but your risk is not defined. Your risk is not defined that time. Your risk comes back to the long call max loss. Okay, it's not like short leg unlimited. It's just that initially you enter into the trade, your loss should be like 300, but because you close your short leg for a little bit profit, then your long legs becomes like naked already, right? So that's the full premium losses. Your loss sometimes that can from 300 becomes like 500, 600 like that. It's not defined. Okay, only do the only manage it this way if you're really good at predicting the wave like an Elliott wave. It goes down, then you take a profit, then the long call will be going up eventually. If you're really that good, you can do it. And some people I see is that the price goes up, they close. The worst part is you close your long leg, then you leave the short leg here. You think that the price will goes up, but your short leg, if the price keep continue went up, your short leg will be your risk is unlimited. That's the worst part you can do. That's the worst thing you can do from this debit spread. So if you are not really that good at predicting the prices, okay, you just define your risk. Keep your spread. Okay, keeping your spread. Don't just close leg out. Okay, close one position. And then you also need to mind the gap. Okay, the weak gap. Okay, because like sometimes like the deeper out of the money is right, your short leg usually the spread very wider than your profit engine long leg. So you just like have to like be mindful about the spread between your width. Okay. So in summary, we just like a trade direction, not explosive. Okay. And then remember, this is mainly for lower down your cost before you're chasing the reward. And it's really beginners friendly, and it's really cost effective for some people who actually have the have the what small account size. So you and then also can define the risk and reward before your entry, and you have to respect the cap profit. And again, you have to think of it like a base hit, not a home run trade. Okay, so so we will be okay. I see some of the questions coming in, and then please look at the chat box as well, because Option Hunter will be helping you to actually addressing your questions. Okay, so like I'll be moving on to the platform demonstrations. Like if let's say you are new to our options pages, make sure you follow our option playbook, because we will actually like share a lot of those strategies and platform tutorials and market relevant insight. Of course, what we are doing here right now is like we are doing fundamentals made easy in this part. I want to make sure you guys to actually understand why we are doing this kind of a spread. Okay. Okay, so now I'm getting into the platform demonstration. I'm going to show you guys what to be aware and then how you actually can navigate. Are you guys ready? Okay. Can exit early or wait until expiration. Just like I got mentioned, like most of the bull call spread traders, right, when you have the profit is almost like close to your max profit, like your max profit maybe like $100, then but if you already have a profit like $80 and then it hits your underlying target price, you can close it. Yeah, it's very rare that actually people hold it until expiration. Yeah, it's very rare. Okay, because you just want to capture the directions. Okay, so right. Okay, I'm going to go into my platform. Like, are you guys ready? If you guys ready, please type 1. Okay, please type 1. Yeah. All right. Okay. So I'm going to move into my platform. Can you guys see the platform? The platform here. Can you guys see? Like, oh, okay, right. So, like, if you are doing some of the blue cross spread, of course, you need to have an outlook, right? So that let's make it very easy, like not financial advice, but just for the sake of the example, we use the legendary NVIDIA's, so that first of all, you have your platform desktop in your looking in your option tab. Okay, of course you have to look at this way. So sometimes the IV is very high, right? But you think that you want to become a directional because you love the RR. So first thing first, you always can check is the IV rank and the IV percentile, is it relatively low now? Okay. For me, because you got H, because so that your Vega also H. So that, but sometimes I'll just look at this, like see whether the IV rank and IV percentile, is it low? Because like if it's low, right, then you actually is like paying a less premium for your profit engine, so that the IV crash won't be affecting you that much. But I'm going to show you, okay, because got one thing is like those kind of things. So assuming that you are having an outlook, so that maybe like you think that the NVIDIA's will be going up, right? And then you can actually is like maybe 36 day you think it will be going up. Then some people will be start from like of course you have to change to custom first. That's my favorite parts. And then you can actually buy one options and then sell another one. That's what you do first. Okay, that's what I usually do first. And then or maybe some people, they would like me, I would just go into the option curve. First thing first, I will see like how much is my maximum loss and how much is my maximum profit. If let's say the price went up like to this until this level, no matter how much it moved at the expiration, I will be only making this much of money. Okay. And then if let's say let's look at the long call. Okay. If you're doing a long course, right, you see the break-even price is like 214.85, and then your exposure is how much? Like $985. It's very expensive, really expensive. But because you sell another legs, then your cost, the maximum loss becomes like 225. So that for those like who have a really small account size, right, this is very suitable. It's very suitable, okay? And then the best part is, you guys want to know like how it works when the IV crash, right? I want you guys to actually focus on the dash line. You just close out your expiration P&L, because expiration P&L, your extrinsic value gone already, so it does not matter. What matters is like if let's say the IV crash. So if let's say the IV crash, sometimes you'll profit because like you still Vega long, you Vega long, but the problem is what? Sometimes if you look at the Vega here, right, suddenly your Vega become negative already. So when IV crash, right, if you landed in this price, right, your both spread landed in this price, your IV crash, sometimes you also can profit out of it. Okay, because your Vega is negative already. It's a bit too I know like I didn't teach Greeks in these sections, but this is how you actually can see, oh, I'm buying this is my profit engine. By right? By right. If I change to default, by right, if let's say IV crash, my profit will be lesser. Should be my engine. But because you got another short leg, your Vega profile suddenly changed already. You see? And then you see your Vega, it will go up, still positive. Here, still positive. And so that your Vega goes up, you still profit. But if let's say your IV crash already, you see, your profit getting lesser. Okay, sometimes you have to be mindful of that. When you do spread, not necessarily your long legs is like your spread is like positive Vega, because like when the price move into this area already, your IV crash, sometimes you can profit as well. So be mindful of that. Okay, so a lot of people miss these kind of things. That's why this curve, these features is helping you to identify whether the Vega is under negative territory or positive territory. Okay. Okay, so you see it from here. Okay, so you guys been asking about how IV affect the whole things, right? This is how it affect. You always simulate like whether if let's say, okay, you always simulate before you entering it into the trade. If the analysis here like IV percentile is really relatively low, you think that it will going up. Okay, you think that it will going up, then you simulate. If let's say it's going up, are you profiting or losing? Lesser profit or like or losing money? But if let's say you expecting the IV will goes down eventually, so that you also can lower down your IV, and then you see like maybe after this happened after 4 days. So how it works? Okay, you see, the lesser the time it is, sometimes your break will far away from your entry, but your IV crush, and how it works. Okay, you can simulate before you even entering into the trade. Okay, this is really important. Okay, why I love to use the option curve, like what I say is like before I enter into trade, I always look at this thing. But eventually, if let's say you don't care this kind of data, I just think that this price will be eventually in the money, and then so because it's you buying at the money and shorting and at almost near the at the money as well. Your spread is just like $5. So both leg both in the monies. You think that eventually both will move in the money. So you just like focusing on here. Then after a few days, maybe if you say you want to close your position, your current P&L will be looks like this, like $97. But if let's say, oh sorry, about 133, but it not really close to your profit. But if let's say it's short further away, and then after more few days you short here, you see the current P&L is 261. While your max profit is around 295, it's uh almost close to your max profit. You can actually close it before the expiration. Okay, so and then another things I like to do is like I usually will do this kind of thing. Like I short one and I long one and short one. I long one and short one. And then I don't like this. I don't like this. So what I can do is that I can pull further away. I can pull further away so that my risk and reward can be higher as well. Like 755 to like but I'm risking more now, but like I having more profit. Okay. But this then some people were saying that but Alvin, this is way too expensive because like but my break even is good. My I think the target price will hit 230. Sometimes you can your short leg can be your target price as well. Yeah, sometimes you can do that. Some people do that. Okay, just for your informations. So that what those small accounts do like is that they lower down your probability for R. Sometimes they look at the delta. Remember I mentioned delta? Delta is your engine. This one is like when you move $1, you make 53. And then this one, you move $1, you are making like 23. So that you move down a little bit. You see the R. It is good now. Like $100 for 4, and you'll have a 4R, but you're losing some of the probability. You have to move beyond 221, you only can make profit. But your R is good. If let's say it really move to this, your target price, like a 220 or 225. Can you see that? So that sometimes you just, if let's say it's too expensive here, then you move down, then you see whether it's like, you see whether like the price from here going to here, is it really ideal? 221, you have to move beyond 221. Your cost is really low at the time. Okay. If you move even lower like this, wow, 17 for 400, but you're losing what? You're losing what? You're losing your probability. From here, you have to move beyond to here. So you have to be mindful when you have to think, you think in terms of the probability. Even though you're lowering your cost, how much you need to do to make profit. But if let's say you think that, oh, I don't want to hold until the expiration. Okay, Ken, no problem. You don't look at this one. You look at this one. If price goes up by maybe after 36, right? Let's make it like until 26 after 10 days. It moved until this level already. Okay. Your max profit is 483, but if let's say during the after 10 days, theoretically, you're able to make like $13, you're okay to take profit it, then you can close the position here. You can. But if let's say it doesn't move, eventually it doesn't move beyond this level, you're losing money, but you're losing relatively less. Okay? Relatively less. So that is this it depends on like whether you want to play like before if you're playing before you want to close before the expiration, you want to simulate within this period. If let's say 3 days, you have to move beyond which level. I only can make theoretically I can make how much profit if the IV goes down, those kind of a thing. Then you should be playing this option curve. you know, just closing this for the sake of the simplicity. No, if I say I want the more probability, eventually the price move in the money, then I don't have to worry the IV and the theta because intrinsic value doesn't decay. You can move something like that. 300. Wow, there's a 2R things. Yeah, it's a 2R things, but it only reads like 332 for 600 something. But because if you plan to actually close before the expirations, right, you can look at this one. And then you go back down. Okay. If price suddenly like really predict you move until like 23230, then how much I can profit? 300 something. But if let's say after 10 days, maybe 26, it only moved to 230. How much we can make? 428. Another 10 days, maybe? 230. 400 something, 486. Okay, if let's say IV crash, 400 something, 230, 600 something. You can see this is how you actually simulate. Like before the expiration, you actually can close already. If let's say crash, then the expiration after 20-day expiration is still not bad, but you just have to move beyond this level during the time. So this is how you actually is like construct your trade. Everyone is different. So it's like some people do it here and here. I just risk $75 for 935. Bro, you need it to move until like by the expiration, the final you have to move beyond 335 point. You have to move $30 at the expiration, you only can make money. But if you only think that after 10 days, then you only move to like 230, maybe is it 230? Yeah, 230. Where is 230? 230, you should be making around like 146 theoretically, around 150. It's still fine. Nothing wrong. Like your cost is like 68, then you'll be making around 1 4 something. Not bad. It's about like 2 hours already. But the problem is you have to move a lot lah after 10 days. But if let's say lesser, it move immediately, then you got more probability lor. If let's say less time, you got less probability. You have to move more. Okay. By today, then you have to move and beyond 220. You only can make money, but less likely lah. Like you have to move this much so that in order for more probability, we move up to see. Let's see, like 205, he has to move beyond this level, then we can make money. IV goes back. Okay, IV goes back because just now IV crash already, right? By default is like that. You have to move, then you only can make this money. After 10 days, let's see. 26. If let's say move to 215, 143, then my loss is about 260. 50%, around 50%, not bad. Okay, not bad. All right. So, okay, let me see some questions. Why every crash leads to more profit? You have to see the Vega because you got long leg, you got sell leg, right? Because becomes a positive Vega for now, but because as you going deeper in the monies already, your Vega value also will change. You know, your Vega value. You see your Vega value getting lesser and lesser. Okay, so eventually, it's right. This one higher, this one lower. You become negative Vega one. You see? If let's say this spread, okay, move in the money, you see this one is lower than this one, right? So it becomes a negative Vega. So when IV crash, you make more money. Sometimes it's you have to see the curve. Remember, you have to see. So you see suddenly negative Vega already. Here negative Vega after the price move deeper in the money. Okay, I hope I do explain your questions. How do you choose the strike price and expiration date? Is there any criteria? How you choose the expiration based on your outlook, you things like how long it takes for the stock to move to your target prices. And the strike price, I just told you guys already, right? You have to adjust accordingly and see the P&L changes, whether it suit your risk and your probability or not. Two things only, like probability, like how far. If let's say I choose here, I choose here, I choose here. Oh, shit. I choose here, I choose here. Yeah, very good. 44 for 400, but bro, you need let me make it default. Because you have to like today move, or maybe like you have to move at the expiration, you have to move to 35. So your probability lesser, but if let's say it hits your R damn good. But if let's say it doesn't hit after a few days, maybe after like left 16 days, maybe he has to move beyond this level, you only can make profit. Not bad actually. It's like if let's say you move like 222, right, you still got one R. Okay, 1 to 1. 44 for 46, around 44, 1R, 1 to 1. Not bad. But if let's say IV crash, ah, that's where you need to consider. The curve, if only move here, then you only negative Vega. But here, if let's say the Vega up, you still profit. You still can profit this area. You see your Vega still positive here. You only, here only your only Vega negative. Okay. Why IV affect the option prices? Go back to basic. Okay, I do explain that. Okay, remember I do explain it. This is all based on the extrinsic value and the intrinsic value. But if you only want the expiration, it's like that. By the expiration, you just have to move beyond this level. Then you close your position. Okay, all right. So this is why I always say it's like P&L curve is the most important things you need in your option trading. Okay, and it's now in Moomoo is really visualize a lot of things. Can you might say, can I adjust here like by looking? I don't want to go back to option chain, look at this mass number, this delta things. You can just doing this lor. Because eventually you just want to look at like how much you potentially can make and lose, right? And then IV drop, time pass, how much right, how much you move, right? But and also the best part is if you want to look at expected move, the price expecting here move down here and here, so that there's a probability, really 68% of the probability it will move to here within the profit range. So it's one of the way by the expiration is one of the way. But remember, EM is not static. The EM can change one. Okay, the EM can the EM because IV change, this range also can change. But for now, you see the price also got chance to actually move within the profit zone at the expiration. Okay. A lot to digest, right? You think I'm going to share only like a max loss to max profit, these kind of things. Like, no. I know that not a lot of people who want to actually hold this until expiration, but this is the worst case scenario you can expect. Okay, this is the worst case scenario you can expect. But most of the time, you'll be looking at this curve. This is more realistic. Okay, how much is changed? How much as the time pass? How much I need the provided? How much I need? You don't look at this blue dot. The blue dot is the worst case scenario, right? You look at this one. You look at these things. You see the red one and the green one. You look at this one. You see the further away, you move away. So that you have to move beyond here, you only can make money. So if let's say I fit here, you have to move from here, you only can profit. But this one are not really that good. Okay, this is how you actually can use the P&L curve. No, a lot of people think, oh, I'm long, I'm debit, then my Vega positive. No, you look at because got one thing that doesn't show here is the Vana, the changes of the Vega. And then if let's say it get deeper in the monies already, how is your Vega works? Okay, got thing is one of the thing is called Vana, because Vana is changes of the Vega, but it not really. But retail doesn't have to like. We might just remembers that as you're getting deeper in the money, you see the Vega pattern. You see the Vega pattern. Oh, yeah. Where's the Vega? You see the Vega pattern? The deeper in the money, the lower the lower the Vega. So if this one is your long leg, this one is your short leg, you have a negative Vega. What? But you got intrinsic value lah this time. If you deep in the money already, by right, you should be having an intrinsic value already. Wait, why got one more? Shit. Okay, you can directly actually remove it. Okay, that's the best part. Okay, and you want to add, you add here. Well, you can buy stock. Yeah, you buy stock, it become like that. So is EM based on ATR? No, it's based on expectable is based on the strangle of the weightage of the certain X weightage of the strangle and the at the money at the and the at the money and the at the money straddle prices and the strangle of the prices, but different weightage to calculate the expected move one. Okay. All right. So it based on why is at the money, because like people are betting on this price probability. So that a lot of people, then a lot is one leg then in the money already, one leg then out of the money already. So like you can use this price, how much the client is pricing into this option price to generate this expected move. You can see the orange line here, the expected move. Okay. It's here. Expected move. 16.953. 16.953. Yeah. Right? It's not ATR. It's not ATR. Okay, it's the volatility option prices. Then you use it as the volatility there to see how much is the expected prices to be reached. And then some people, if let's say you advance, right, you don't like this expected move, you can actually create your own expected move. Some people use the VIX to multiply and divide square root of the expiration. If you really know how to do that, you can do that as well. I do that as well sometimes. Okay. Not sure whether you guys interest like how I use how I got my own expected move also. If you guys keen, let me know in the chat box. I will be sharing it as well. I will use this also. Okay. Don't think that I have a proprietary range. I don't use it. I use this. Okay. I do use this. This is a one standard deviation. Okay. If let's say like you want to like know two standard deviation is how much, you go to here. You visit the analysis, you can see the probability analysis. Okay. You can actually see here, if let's say two standard deviation, how much is the different expiration will be expecting to be travel, how much probability will be getting in the money. You use this probability analysis. Okay. You use the probability analysis. Like if let's say how people actually using this, if let's say they are those very kiasu one, very scared. One standard deviation, 68% of the probability it will travel between here. So if let's say you sell a call option here and sell a put option here, so I can collect the premium, but only 68%. I scale like the price will be hit by hit me. Then I see like two standard deviation, 2, 2, 3 are here and here. The price got more probability, less probability will hitting here and here. So they sell these two late. But I scared if let's say economy it hit me already, then I unlimited loss. So I add another leg, it become an iron condo. So some people use this. So you guys have to like start exploring this kind of a strategy, the features. Okay. Then you say, I don't know how to use. Okay, I'm teaching you now. Some people they sell outside of this leg. 1x6. So you see, like let me put it bigger. 1x6 and 223. Then if you put 224, 1x6, then it won't touch 95% of the probability it won't touch based on the current IV. You sell one, then you buy another leg, buy a higher strike and buy a lower strike. Like how like for example, it's like 223 and 1x6, right? For two standard deviations, okay, not one standard deviation. This one is one standard deviation. Okay. Sorry, I forgot already. 223 and 1x6. So 223. 223. Okay, there's no 223. So I think I will use sell a 225, then I buy another 230. And then what's another one? 1x7. 1x7. Okay, there's no 1x7, then I use the 1x5, then together with this. So it become iron condo already. So I'm risking 3 and 1x for 1x2 for because of this standard deviation, two standard deviation. After expiration, as the time pass, I'm making, if let's say it stay within this range, I'm making profit. But if let's say go way beyond, losing 300 something, this kind of thing, no? IV crash, more good. If let's say IV crash, you see, IV crash, you make profit. Okay, you make profit. So how under what circumstances you want to do these things? Okay, I'll just close my video. So important or not. So like use the P&L curve. Without this, how you want to trade? Last time I have to pay to use this tool, from the third party platform. Now it's completely free. So good. You guys are so, you know, you guys are in a happy world, I would say, in a happy world. Okay. So, and then yeah, that's the whole section. It's like I do hope you guys like learning some learn some things. So of course today is not about this thing lah, not about this thing. Okay. It's of course it's the debit spread. Be mindful of the things like uh that I mentioned. Do I have to download Moomoo apps in the desktop in order to have access to the current stream? I went to but I couldn't find the page. Couldn't find the page. Let me see. Not sure whether I can see. Let me see. Let me see. Let me see. Um, that's, hold on a second. We couldn't find. You just go to this website and then you go here. You just press download now, or you can actually view more version. It's here. Moomoo desktop. Moomoo desktop. Then you can download your Windows version. If you're using Mac, then you can download the Mac one. Okay. You download the desktop version. Okay. Just press download, then you can get the features ready. Phone. Yeah, you can get the latest ready. Okay. Right. Can I first sell today, then 2 days later buy put instead for no, because that's not debit spread. That's your that's the different thesis already. Because you are thinking to sell put today, then 2 days later you buy a put. 2 days later, how you want to predict to predict the price changes? You might be eventually your put will be more expensive than your buy. If let's say the price went up, your sell put expensive already, then you want to buy the put back. You buy the put at the if let's say because the put price increase. I assume that your buy put the buy put that you plan to buy 2 days later also expensive. So you're paying more insurance. Then your spread become no matter how you also lose money already. Only when your sell put, then your sell put, then the price went up, it goes down a little bit, then you add another leg, then makes sense lah. But if let's say goes up, that's the kind of the risk that you need to be aware. So that's why when you do debit spread, make sure it's together. You sell one by one. You define already because you never know. You never know. That's a tail risk. You never know. You want to you assume that the price you sell put first lah. Let's say, but the price the underlying price suddenly goes down. Then it increase already. Then at that time you want to buy back buy back, right? It become more expensive already. No, like that's not debit spread. Okay, that's a whole different thesis. Okay, that's not debit spread. It's always keep yourself safe because like you are doing a naked. Like when you sell food, you're doing a naked. There's unlimited losses. Unlimited losses. You buy here suddenly you buy back one put at the expensive level. No. So that's why I say like in the PPT, don't leg out. Never add leg out. If you don't know what you are doing about your max loss, because your max loss can be undefined. The main things why debit spread exists is to lower down your cost because very expensive, right? This one very expensive. So I lower down my cost. You want to define your risk, also keep yourself safe so that you can this time, if this time lose, then it's okay. You define your risk already. You still can go back into the market and then trade smaller. Because your account equity curve don't have to rely on one trade to win money. You can attempt many times. There are a lot of opportunity. Don't wipe out your account. The first rule is never wipe out your account because you need to like keep in the market because there are always chance. Okay, don't rely on because I want to make a big bucks, those kind of thing. No. Okay? You want to make both profit, those kind of thing. Always define your risk first, okay? Okay, don't wipe out your accounts. I want to keep you guys safe, like a lot of people do this kind of thing. I know what you are thinking. I want to profit from both sides, right? That's greedy. You never know. You never know. Okay, you never knows. Like out of a sudden, Jensen Huang say or resign already. Then how? Market went down. Then your put suddenly very expensive already. You want to buy back also very expensive already. So you lose a lot. Don't do these kind of things. Like you have to stay in the game. Stay in the game. Then eventually, if your approach is correct, then your equity curve eventually goes up. You have to manage your drawdown, manage your defined rates. I hope you do get the idea. Oh Hong, is it Oh Hong? Yeah. No, I'm not. By the way, I'm not scolding or anything. Sorry, yeah, because I'm just trying to protect, protect everyone's like who trying to do this thing because it's really dangerous. It's really dangerous. Okay, right? So yeah, don't angry me. don't don't angry. Okay, I'm just trying to like sending the right message out. Okay, because I've seen a lot of people do this kind of thing, then wipe up their account. And then I don't wish that happen to on you. I really don't wish that any of our followers doing those risky things. My rules is always like define your risk, define your risk, define your risk. Okay. Then if you want to then when you're really good at directionals and directionals like this and or probability like this, like how much is the do you think that within the 36 day it will move beyond 240 or 230, sorry, 330, those kind of probability things. Yeah, so it's entirely up to you. So that and then okay, yeah, that's the whole sessions. And then okay, because it's already 9 o'clock, but I want to spend a little bit of time to actually chat with you guys. This is the chapter 8 already. Okay. There's a chapter 9 is chapter 9 is actually go back to like long call and long put, but you'll be surprised. I'm not just teaching long call and long put that simple. Okay, especially when platform demonstration. For those who actually left already, okay, you don't get to see those things. Okay, can you set your debit spread? Moomoo can automatically for you to actually hit profit. I don't think we can now, but you actually can set the target profit like GTC order in your apps, if I'm not mistaken. Okay, you can actually explore, right? But usually I will manage my position when it's hit because like my some of my debit spread you should sometimes like my view is very long, 64 days, very expensive this one. Yeah, it's buy one sell one. Then it I have a lot of times to actually decide when I want to close my position. 都敢用 one. Okay, okay. I want to spend a little bit of time to actually ask you guys like after the sections end already, the option playbook ends already. You guys know what I'm going to share after that, right? Anybody knows? Can anybody chat in the chat box? Put it in the chat box. You know what I'm going to do next? Okay, iron condo. Okay, iron condo. Yes, yes. I'm going to do iron condos. Okay. The ways of iron condo is just like telling you guys like how to define your risk, those kind of things. Okay. So and then also from a probability standpoint, okay, like especially for those like who love to do something like this. Like if let's say I want to predict this price will go up and down, it's very hard. But if let's say I want to predict it won't go beyond this range. It's compared to predicting the direction is much more easy because within this range, I also can profit. Like what I just showed you guys, iron condo. Okay, I'll be showing those kind of statistics, the equity curve, those kind of thing. Okay, I'm just having a little one question. Do you guys like this kind of idea, like sharing the strategy, not only on like iron condo, but also like in the trading perspective? For example, like do you guys want to know like some of the based on the backtest strategy. For example, I backtest a strategy, then strategy says that every time it hits here, then 70% of the time you can profit. Then you it's a backtest thing. It's a mechanical systematic strategy. So for example, it's like if let's say the strategy is suddenly like for example Bollinger Band, if the let me see like can I get Bollinger Band example only no financial advice because and is never been I got the data lah, but like yeah, what is the oh yeah indicator is a long time didn't use here because I look at option chain log. Okay, the Bollinger Band. Okay, that's the Bollinger Band. So let me see like okay upper mid okay. Let me change my color. Green, orange, orange. Okay. Okay. So you guys may want to know, right? Sometime if let's say, okay, do you guys okay? Just a very question. If let's say you guys not keen into these kind of things, right? Then I don't share. Okay, I will just share those spread. If the price close below this orange line, okay, then you buy. Then if let's say the price close buy because this one closed already, like you buy the next day open. Okay. But if let's say how you close, if let's say it cross the middle line, close above the middle line, then you close. Okay. For example, this one condition fulfilled already, then you do a spread here. Then eventually this one cross above here already. So you close above the middle line already, then you exit here. Do you guys love this idea? Like backtest historical data for education purpose only because it's just like I'm just sharing those kind of research I found. And then but by the way, historical data doesn't mean reflect futures, but it's just for study purpose so that everybody can build their own playbook. That's the whole idea. Okay. For example, it's like sometimes like people's like when here they when we close below, right? Then they do what? Because it's low already, likely the IV high. So they do a credit spread. Then even here already it close back. Those kind of a thing. So this is like how you actually like like how those research actually is like comes into it. Remember I says like probability and the entry and the back test those kind of thing. The number tells a lot. Yes, I do those kind of thing. I'm not sure whether you guys interested or not. If let's say you guys not really interested, then I'm not sharing because like you become a very boring sections. Yeah, it will become a very boring sections. Okay, it's just like a statistics study. Okay, but by the way, just now I mentioned the strategy is not really my the strategy. I'm just sharing the not financial advice because like I'm just sharing like as an example, like the based on some paper of the studies, those kind of thing. You know? Okay. Okay, so if you guys do interest, then you have to like move then I'll be see whether what can I share what can I share about the strategy because I do a lot of back tests. I do a lot of back tests. Usually if you guys wondering what I'm doing, I usually back test the strategy, then I walk forward, then I do the Morton Carlo and then I do the Morton Carlo and then see whether if let's say optimize already, is the Sharpe ratio still good, those kind of thing. Yeah. That's what I do as a traders, you know. And then uh I did told you guys I was a discretionary traders, like I draw line as well. So nowadays I very rare to actually draw line. Then sometimes I look at last time I look at macro, but now everything I do is just backtest because I'm a systematic traders. Okay. Yeah, that's the whole. I see a lot of people in like some of them interest only. Yeah, only the few. Yeah. So yeah, that's the whole things I want to deliver. If you guys interest, then yes. But first before that, I'm going to show you guys the iron condor, those kind of things, right? And then how you actually is like can because like if let's say not a lot of people interest in this kind of things, then there's no point for me to actually share this education research paper that I found and show you some data, you know. And then yeah, Ion Condo, yeah, one of the things that I've been working for with so long already because neutral strategy and because a lot of retail traders doesn't really good at predicting the price, right? Some more they are very bad at predicting the direction. They still want to buy call and buy put. That's a problem. Like every time wipe out their sideways, wipe out their whole premium already. Okay, wipe out their premium already, and then you love to buy call and buy because simple. But simple doesn't mean you'll be profit. Okay, because that's why I'm doing all these things. Like I'm doing a long call. I do spread, lower down your cost, those kind of things. If you're really good at directional, do spread lah. Lower down your position sizing, those kind of things. Will there will there any have any spread like butterfly and calendar? Uh, okay. Butterfly, I don't really do it. I know how it works, but I don't really do it. I think our win sections can cover that. If he could do a lot like iron fly, iron butterfly, those kind of things, you know. And then calendar spread, yes, I do calendar spread as well. I'm not sure whether I can cover that because a little bit advanced. I'm not sure whether you guys can take that. If you guys can take butterfly and calendar, I can cover butterflies. Okay, I can cover. Okay, you see option hunter, you say you can cover. Okay, just like I do calendar. Okay, I do calendar, but my calendar a bit different. My calendar is double calendar. Okay, double calendar, and then I do it under certain condition. Okay, certain condition. What is iron condiment for? Okay, you'll be no. Stay tuned, and then make sure you follow our option playbook, and then share. Okay, because like I need you guys to actually share like me and LV, sometimes we share our life, right? Those kind of things. Like sometimes you guys just watch, and I'm glad that you guys had watched until the end. But I wish you guys to actually share to more people as well, like share within the community, or maybe like share to the maybe your Facebook or anything. Like I wish you guys can share so that like if let's say for those who want to learn also can learn because I'm doing it for free, like by right, I should be like having dinner now. I still haven't had my dinners, but we are still here. Like me and Alvin still here, like doing these sharings, and then for free, because actually, last time when we trade, really lonely. I tell you, just one man show, nobody will talk to. Okay, even though like yeah, Moomoo support advanced multi-leg strategy. You see, option hunter very happy when you look at when you when you say butterfly those things. That's his option hunter things. You know. So I think I just made my you know like hope you guys do actually enjoy the whole sections, and then if you guys do really enjoy, I hope you guys can share it to like friends or maybe like your pages, those kind of things. It does help. It does motivate me to actually share more. Because if not, then no point for me to actually. Yeah, you guys have meant a lot for me, but uh, yeah, I wish a lot of people get this kind of education for free. Because you see, like I don't give tips. I don't give tips, but I only teach you guys how to fish. Okay. And then these are the rope, man. These are the rope that allows you to actually uh able to catch the fish. Okay. I don't spoon feed. And it's free. I don't charge. I don't charge. Okay, I'm going to end my sections now. So I hope you guys do enjoy the sections, and then I'm going to have my dinner, then um, continue my works, those kind of things. Like so. Yeah, thank you guys. Thank you guys. Stay until the end. So like, I hope you guys do enjoy. Yeah, I said it many times already. Right. Thank you very much. Thank you very much, guys. So yeah, no problem. No problem. Thank you. Thank you. Thank you. I'm going to end my sections now. Thank you.